Welcome and thank you for joining us for another episode of Venture Voices. This is our deep dive into the VC ecosystem and the exciting world of startups and scale-ups. Delighted to be joined by Jonathan Lerner from Smedvig today. Great to meet you again, and look forward to kind of throwing lots of questions at you.
Yeah, pleasure to be here. Looking forward to it.
I guess to kick off, we'd love to kind of understand a bit more about you and what your journey looked like on the journey to Smedvig.
Yeah, so I was an engineer by university. So did electrical electronic engineering for 4 years at Bristol, and then joined a management consultancy called Bain. Spent 5 years there consulting mostly large cap companies around the world on various different topics, and had this idea that it felt like this a while ago now, digital was going to take over and consultants were going to struggle to keep up. At least some of that was correct. Actually, the venture world would be a much more interesting place to be, actually investing in some of those businesses that were going to take over.
And the move to Smedvig, were you looking at PE? Were you looking at VC? What attracted you to Smedvig?
Yeah, interestingly, I wasn't looking at PE at all. I was really excited by novel technologies and young companies really changing things. And so I was very focused on VC. And I loved the blend of long-termism that a family backing could give, as well as being excited about backing novel businesses that Smedvig had.
And it's fair to say that longevity of the investment means there's a potentially perceived closer bond with the founding team and maybe slightly more supportive. But what do you see and kind of what investment stages do you go on that journey with founders on?
Yes, a few different questions there to unpack. But when I first joined, we very much avoided the term family office. And the reason why we avoided family office is because in the market, it was seen as a negative for a few different reasons. I think that has very much changed now. There are a lot of very high quality family offices doing high quality direct investing. And so founders understand that you can have a best of both worlds type approach, which is what we try and do. So we do back Series A businesses, have product market fit. That's the majority of what we do. A little bit of Series B all across Europe. And so we're really backing very fast growing, innovative businesses that are changing tomorrow's world.
It almost feels like there's a blend element to VC track, long term. Kind of obviously PE is not always long term, it's 3 year, 5 year gig, but it feels like you can fall off VC track pretty quickly, but perhaps there's a longer term end game with a Smedvig investment than just a pure VC play.
Yeah, I think every business we back, we want it to be on the VC track. We're backing businesses so that we can support those founders to get from where they are, let's say about 1 million of ARR, through to a really big business. That is plan A. But I think we're also cognizant that plan A doesn't work out for everyone. And so we push them really hard to stay on plan A. But when it becomes clear to everyone that we need a plan B or a plan C, we're there to try and help co-create that with the founders and work out what that might be. And that's loads of different routes it might end up taking.
What, obviously in the last 18 months, 24 months, plan B and C and D and E becomes more of a thing, actually. So you're probably, of all the VCs or family offices, quite experienced in knowing what that looks like. And some of those outcomes can be still equally very positive. So what are some of the outcomes that are feasible that you've seen in the last 3 or 4 years that perhaps aren't traditional, Series C, D, and then, trying to target an IPO type route?
I think, as you said, there are so many different iterations of that now. Ultimately, cash is king. It's sort of an old adage, and it's still true. As soon as you get your cash burn down to zero, then you're in control of your own destiny. And so we talk internally, and I think people externally talk about as well, the valley of death. This idea that actually if you have a SaaS business, the majority of businesses we back are AI-enabled SaaS. If you're sub 10 million of ARR, it's quite difficult. If you're sub 5 of ARR, it's almost impossible to be break even. Once you get through the 10 million ARR, it's very possible to run your business profitably, and then you can take whatever route you want to take. And so it's really about finding a path through to that cash flow break even, and then deciding, are you exiting at that point? Are you trying to find someone who do a majority recap at that point? Are you going to struggle to get there? And then are you working out ways that you can improve your strategic resonance with some of the buyers that might be the ultimate acquirers?
Yeah, that's super interesting. What are some of the hygiene factors you look for from maybe pitch deck to first call to second call?
Super interesting. So pitch deck to first call, it's an intriguing idea at about the right stage in the sectors and geos that we want to cover. Then if we look at first call to second call, it really is about the founder, the sort of traction, product market fit, how rapidly is it growing, if you like, as a proxy for product market fit, and how big is the scale of the opportunity.
And when you look at the founder or founding team, obviously there's a review of the quality of that and the makeup of that. What's really important for you when you're looking at a founding team or a founder?
Yeah, so we look at both. We're happy to back founders and founding teams. There's pros and cons of both. I think when we're looking, let's say single founder for the moment, or a founder, CEO, we're looking a lot at founder problem fit. Why are they the right person to solve this? Then we're looking at all the classic things VCs will talk about. We're talking about energy, responsiveness, clear vision and demonstrated ability to articulate a strategy and why they're going to win and how they're going to win.
And the sales piece, obviously, ARR doesn't increase unless someone can find product market fit and sell the piece. And we had a really interesting roundtable with CFOs this morning, actually talking about the founder that was the sales lead getting to a 5 million, 6 million, 10 million revenue business, and then feeling like a weight's off their shoulders, perhaps because they're at a stage they can bring in a chief revenue officer or a sales director, and it feels like, I've done 5 years, it's been a hard slog, we've got it to an 8 million revenue business, I can now kind of relax a little bit. And quite quickly that's when these long sales cycles kick in and the conversion rates drop off. I mean, how do you feel about who sells the product, how well they sell the product?
Yeah, so almost every business we back, there is a large element of founder sales still happening, whether the founder is a salesperson by background or a product person by background or a tech person by background. Because ultimately in a small business, they are certainly in B2B, they're out there selling because they have the vision, they have the ability to construct those relationships, and they probably don't have that many other senior people in the business. Now, depending on where their background is will depend on how quickly they build out the team in which places. But ultimately, that journey as a founder to CEO is one of the fascinating bits of the journey. They have to go from being a founder entrepreneur to being a CEO entrepreneur. And we think about that happening between Series A and Series B predominantly. And the reason for that is that's when you start to go from a small business where everything happens by osmosis. So whilst you're the CEO, it's very collaborative, it's very team. By the time you get to your Series B at maybe 50, 60 people, you have structures, you have middle management, you have an ability to control and manage via other people. You have to hire really brilliant people such that they can then push the business forwards.
And do you have an inkling when you invest at a stage when it's 40 people, could that person be a 100-person business CEO?
I genuinely think everyone we back, we believe can make it. Now, either in their past, they may have demonstrated that, they might be a second-time founder, they might have done really big GM jobs before, but we wouldn't back anyone who we don't think can be that 100-person founder, CEO. Does it always pan out that way? No, it doesn't. I don't think many of the founders themselves know, because often they haven't done that role before. Even if they've been a GM, they might not have been a CEO of a whole business before. Even if they're a second-time founder, this business might take a very different route to their last business. So I don't think anyone knows, but we wouldn't get excited and put a term sheet in someone who we definitely thought that's more or less that person's not going to work out.
Yeah, there's no logic of backing a business at A stage that's 3-4 million ARR, knowing that you're going to have to bring in a CEO
No.
and that person moving to continuing in product or sales.
No.
There's a full belief in the individual, which I think is...
Yeah, and we often back businesses where the founder themselves is pretty self-aware of their strengths and their weaknesses. And when they describe how they want to be CEO and how they want to scaffold around them, you could easily describe that maybe as, well, you're really chief product officer with someone else doing a lot of the ops. But that's fine as well. They're still CEO. It's just their CEO, and they know their strength is product, and that's what they want to lead. And they know potentially their strength isn't ops or sales. And so they want to make sure they get really brilliant people to lead that bit of the business.
I'd say awareness of strengths and weaknesses in that role is as important as anything, right?
It's absolutely critical. Yeah.
Where do you normally plug in around them what becomes essential for Smedvig to support them on generally?
Yeah, really interesting. Different for every founder, ultimately. Obviously, given this conversation, CFO is really important. Often when we're backing business at Series A, there is no finance infrastructure at all. When we do financial due diligence on the way in, it's what level of chaos is sort of what we're expecting, really. And so we always say there's a finance hire to come in. Now, whether that's a financial controller or a VP or an FD, that's a long conversation that we sort of iterate depending on the exact needs of the business. But that is a key hire on the way through. And then, as we said, depending on where the founder's skill set lies, we're then thinking about how do you bolt in a CRO or a CPO or a CTO. But that C team needs to get built before you get to Series B, really. Obviously, if you have multiple founders, that then looks like a different journey.
Yeah, it's interesting because there's obviously bringing in an expert into these different functional areas, but also allowing there to be less distraction to a founding team that are building a great product or winning business, because a very strong strategic investment banking Bain McKinsey type founder is perfectly capable of doing the CFO role and the CEO role. But it is, depending on the volumes, the complexity of the international entities, doing something that you're not an expert in exudes more energy. So naturally, it's going to dilute what you're doing as a leader of the business to investors and to the company.
I totally agree. I think on average, founders, the CFO role or the finance role is the most underestimated role from all the different roles by founders. And that's because I think intrinsically they know that if they want to sell stuff, they need a sales team, they need a head of sales. If they want to build product, they need a head of product and they need a head of tech. That sort of all makes sense to them. And the finance role is often missed, I think, by them. But it is really important, not just for, as you were talking about, getting the nuts and bolts to work that they may not be familiar with, even if they're sort of intellectually perfectly capable of working it out. It's how do you construct the operations within the business so it's streamlined, so that it's not lots of manual lifting? And how do you create the information within the business such that you can rapidly make the right choices? And I think that's what a lot of founders miss, that if they don't have a great finance infrastructure, they're not going to have the right information to be able to make the choices they want to make at lightning speed in order to iterate how the operation of the company is working to maximize the growth.
And do you think that's because ultimately they see success as an ARR number?
Exactly right, because if you jump forward a few steps, which founders are known to do, ultimately the finance bit doesn't matter to a certain extent. ARR matters. That's what they're going for. I'm going to make great product. I'm going to sell it. I'm going to grow this business really quickly. Everything else becomes second order to them, which is true actually in the early stages. Obviously, as you get later, you care more about gross margin. You care about your sales effectiveness. But what they miss is that the route to that fast growth or sustaining that fast growth is really understanding what is working and what is not working, fixing the stuff that isn't working, doubling down on the stuff that is working. But in order to understand that, you have to understand the data that sits within the business. And with the advent of more and more AI tools, etc., the amount of data that sits within even early stage businesses is amazing. And the amount that you can use that early stage data is really, very powerful.
It's interesting because obviously all founders naturally have a huge ambition and an ego. Everybody's got an ego, and if the business hasn't got a massively defendable moat, it becomes a sales-focused approach. A bigger or higher quality sales team will drive revenue growth, which means we can be successful. If it does have a moat, how do we keep that moat? What new products can we add to it whilst we've got that defensible position? So it's so easy for runway to be eroded on the sales teams, marketing teams, and product development before even a finance person comes in. And then when the finance person comes in, inevitably, quite often they come in and go, actually, do you know runway is 6 months, not 12, based on where we are? And that's quite a negative connotation of what a CFO does. But I think what you're alluding to is they have access to all of the data feeds in and out of the business based on kind of the sales funnel, the marketing funnel, the product funnel, and actually they are they're an expert at actually presenting an argument to a board on how the capital is allocated on different growth levers.
I think that's absolutely right. And it's not just to the board. The board is one set of people who hopefully can help a business grow fast. We try really hard to be value-add board members. But actually, the majority of that information is going to be used within the executive team to help drive the decision-making. And then some of it will surface up to the board. But it really is, it's day-to-day. I think it's quite dangerous to think of a CFO as someone who builds reports that the board look at. I really don't like that version of the CFO, actually. I really like the version where they are driving change internally, whether they're driving the change themselves or whether they're driving change because they're giving everyone a single source of the truth that can help everyone make better decisions on what they're doing.
I mean, the single source of truth thing is massive, right? Everyone's
like everyone's
dream of that. But so in your world, does data fall below a CFO?
Often different businesses are different in terms of how they treat it. So RevOps comes to mind because we were talking about what's happening in the sales funnel and what's effective. And some businesses, RevOps sits beneath the chief revenue officer. Sometimes RevOps sits within the finance domain. I don't honestly think it really matters. I think what really matters is that RevOps is there and there is a single source of the truth when you get to an appropriate scale.
Yeah, and if it's a high volume, low value business or the alternative, there's different key metrics to look around net retention and profitability by client and lifetime value and all of that good stuff. And there may not be anybody that's done that before in the business or a founder that's trying to cobble that together, not brilliantly. If they do come from a finance background, they can probably be the high level individual that analyzes that, but they still need a controller or some form of head of finance to do all of the systems controls and data quality to get it to that point.
Yeah, again, we're talking potentially different stages of business here. One of the difficulties of working with a founder and trying to decide together what the right level of finance hire is that everything's going to change really quickly if you're on the path you hope you're going to be on. And so the right answer for today is not going to be the right answer for 24 months' time, maybe not the right answer for 12 months' time. And so you just got to take a view on what you think the growth path is going to be and therefore how you think you're going to stack things up. And you sort of have to gaze a little bit into the future of your future operating model. But given how fast you want to grow, you can't gaze too far into the future, otherwise you'd have a totally inappropriate, not nimble enough model. And so that debate is always live of what level of person do I want now? How do I get the doer and the thinker? I'm not sure I want two really senior roles now. How do I bolt in a senior role and a junior role in what order? That's a constant debate.
Yeah, it's obviously a fun one for us. We enjoy that debate. Actually, it's really, really quite an exciting stage for a business to go. This person is going to solve these immediate milestone and challenges, but also I think there's enough bandwidth that in 2 years, 3 years time, they can still be here, and we've got a brilliant setup. When you look at metrics, growth metrics, what's really attractive for you? Obviously, you talked about the founding team being super, super important, but you're looking for obviously underlying metrics of performance. What do you look at Series A, or whether you follow on at Series B?
So at Series A, growth rate is key. And so everything we look at, I'd say, has grown let's say 150% plus to get to the million ARR. If that's the bottom bar of where we'd back at $1 million, then it's grown 150% plus to get there. Maybe, but often much more than that.
And that's annual.
Yeah, exactly.
Yeah.
Yeah. So it's grown. It's grown. It's way more than doubled to get to $1 million within a year.
Yeah.
That's the benchmark. We'll talk on to Series B in a second. If you then look at what are the other metrics that are important, whilst they will still be early, we will look at GM. We want to understand where GM is, where we think it's going to get to. That's important that we think there's an end point there where it's landing at good SaaS margins, so 85, 90%. Now, increasingly, we're seeing, of course, some AI burden in there, and that can depress gross margin, but it's really important to take a view of how that's evolving and where it's going to be. And then net retention is probably the next most important one, which is you have to be growing your existing customers. As soon as you get to the point where your net retention is lower than 100%, you end up with a leaky bucket problem of some sort, which is that if you want to grow, not only do you have to add the amount that you wanted to grow by, you also have to replace everything that's come out from below. And at the 1 million ARR mark, that's really easy because the percentages just say, well, okay, if you're 95% NRR, you only lost 5%. That's a small absolute number of contracts you need to land to get there. If you wind forward to a 20 million ARR business, that same 95% NRR becomes very, very difficult. And on the flip side, if it's 105% NRR, then you've got this great big sort of tidal wave behind you when you're doing your budgeting of, okay, we want to grow, we're at 20 million ARR, we want to get to 30 million ARR at the end of the year. But if you're going to grow 105% NRR, you're suddenly, your new cadence that you need to hit with your sales team is that much lower. So super important. Then the last one we track really carefully is CAC to LTV. Is this just a money machine where you just have to pour more and more and more money in the top to actually make those sales? Or is it not? The reality is the CAC to LTV, what's workable there, both CAC to LTV and payback period, depends then on what the churn rate is. The longer and stickier it is, the longer payback period you can sustain. The more churn you're seeing, then you have to bring it right back.
And obviously on growth rates for A, we'd looked at 150%. What are you thinking 18 months down the line to still want to invest in it again?
Yes, I probably think more about market rather than whether we'd want to invest in it, because we said there's multiple different tracks that we might try and support. The reality is, I think if you get less than, let's say you're then at 5 to 6 million ARR, for argument's sake. Let's say you've got a really good SaaS business that is low churn. So all the metrics are lovely. NRR is good, GRR is good. We've got a business that's nicely strategically positioned, good market size. I think if you're less than 50% growth and you're capital efficient, so you haven't burnt too much to get there, if you're those two, you can just about raise. That's sort of I think the bottom bar. If you're not capital efficient, so you've spent quite a lot of money to get there, you need to be growing at much more than 50%. And if you want to be in what I'd call the top tier of B funding, then really you need to be at the 100% plus.
And does the gap from EBITDA positive or profitability become a thing at this stage? Obviously you talked about being capitally sensitive and not kind of having to spend obscene amounts to get to the growth metrics we talked about. Obviously, as a result of that, they're going to be nearer to profitability.
I'm not sure they'd be nearer to profitability because they might still be investing very heavily in product, for example. Okay. They might be ramping the sales team really quickly, and there might be a period where you burn before they become productive. And it sort of comes back to the finance. If you can explain why you're burning lots of money and it is deeply logical, then you can burn lots of, and you're getting the growth rate off the back of it, and it's a sort of, which these businesses are, you have to invest ahead of the curve, then I think you can really explain why you've been spending the money and where it's going to take you. And so then the burn rate is fine as long as you have the growth to go with it.
Which I guess is a great example of, all of 2020, all of 2021, the first half of 2022, where a lot of that spend was happening without perhaps thinking about the consequences.
Yeah, I think that what was happening then is it was growth at all costs or any cost, which just doesn't make sense at some point. If you're investing $1 to get 25 cents back, well, you're growing, and you could grow very quickly if you invest enough dollars, but it just doesn't work. It's not a sustainable business model. And so I think people have realized that actually there is a balance between speed of growth and starting as you scale to show investors that at some point you're going to create EBITDA and you are investing ahead of the curve because you want to keep growing quickly because you have a massive opportunity. But at some point down the line, there is EBITDA to come.
It must be really nice to see the evolution of the confidence and professionality as a business, not just the CEO, but, obviously a CEO and a great, kind of C-suite team. Board pack is out 72 hours before the board meeting. It's highlighting different members in the team, what they're focusing on, what their priorities on. That is such a progression from 18 months before. It must be really nice to see kind of that. What are some of the signs you see that a leadership team and a CEO is working?
It is that hiring A players. You can, as they haven't hired many of them often at Series A, you can see how things are progressing quite quickly because you can see the CEOs who bring in fantastic people who are objectively better than them at X or Y or Z, and they are really comfortable with hiring people who are better than them at something and empowering them to go and do their thing. And where that happens, you can really see the momentum in the business start to build because the capability is there that the founder's not trying to do everything. And then, as you said, you watch this progression of the founder who was amazing demonstrably at lots of things when you back them at Series A, suddenly blossom into a different amazing CEO because they've gone from that founder entrepreneur to founder CEO. So we talked about it a bit at the beginning and we talk about it a lot at Smedvig.
And it's not easy to do, is it?
It's really tough to do. It's basically a completely new job.
Yeah, and therefore it's not a surprise that people fail at it regularly.
Yeah, I think it's not a surprise that people fail at it at all. And I don't think it should almost be considered a failure. My view is it's such an amazing achievement to have built a business from 0 to $1 million of ARR or $1 million of anything. I think the value that you've created for your clients, for your employees, that is an amazing thing to have done. And I don't think anything beyond that should be considered a failure. I think a radical success. Now, whether you're the right person to take it through all the way as far as the business can go, who knows? But either way, you have succeeded. You have been an entrepreneur. You've created something amazing. I'm actually quite anti the cult of the sort of super entrepreneur where you've only succeeded if you've raised $1 billion and you've created this. There are so few businesses that will ever go on to do that if you're an entrepreneur and that's what you aspire to, you've set yourself an incredibly hard goal. And there are many founders, who have found themselves creating quite big businesses, but with so much venture funding that the funding has always been slightly ahead of the value, especially as we've gone through 21, 22. Has that actually created as much economic wealth for them as creating a much smaller business that they owned a lot more of would have done? I know many founders aren't in it just for the economic value for them, and that's great as well. Some of them just want to build big businesses. But I think there is the non-venture path is equally as valid for most founders, actually. That's the reality. Most businesses shouldn't be venture funded. That doesn't mean they're bad businesses at all. It doesn't mean they're not successful founders at all. It just means they're building a very different business.
Yeah, so true. We're seeing an increasing number of bootstrap businesses that have got to 10, 15 million, and it's like, this is incredible. You've got to 15 million bootstrapped, you've got 80 people, you now want to do a partial PE raise and then go down the full exit route. It's not just about financial gains, but the financial gains of that versus maybe the VC track are going to be, significant.
Yeah, it's a fantastic position for people to find themselves in, and they will have been capital efficient the whole way through because they are forced to be. The negative of raising a big A round or a big seed round is it's difficult to maintain the same cash spending discipline that you might have had if you were bootstrapped, because you have the capability. And to some extent, you'll be pushed into spending it and hiring roles and all those good things. And that's what you should do to grow your business more quickly, which is what everyone wants. But it's tricky while you're doing that to maintain as much cash discipline as you can.
It's funny, as you talked about A players, and the way that obviously A players are, 100% I agree with that and all of the points around it. I think you can see the weight on someone's shoulders when they don't hire A players.
Yeah, I agree. If you don't hire A players, you constantly worry about what they are doing, and then it can become quite a destructive circle. You worry about what they're doing, you do their work for them, you don't empower them, and you just quite quickly spiral down into getting rid of them. Or you do leave them and you get almost a super cycle of, well, they can do whatever they want, and then 9 months later, oh, this is completely broken, we need to replace them. And so neither of those two really work. And founders who, I know some founders that they aren't great at hiring A players. They hire people who are going to be a little bit more subservient, BC players, and it doesn't work.
Well, they're also thinking, they're 40,000 less on the salary bill or 50,000 less on the salary bill. So there is a logic to it but you've got to fight against it to get the A players. I think I actually, as we're having this conversation, I think about when I meet founders, CEOs, and they walk into the room, I could almost tell if they are talking to me because they're trying to replace a B or a C player. Their shoulders are hunched over, they're low energy, whereas someone that is going about the hire for the first time and wants to get an A player, there's kind of a spring in their step. It's a bit simplified terms, but
yeah, we talk about founders having the time to work on the business, not in the business, and that's what A players do for you. You basically recruit yourself out of a job. The job that you were doing no longer exists because it is done by everyone else.
Yeah. And
some entrepreneurs are really comfortable with that, and they are excited about moving on to the next layer. And some people find it very difficult to let go.
And I think, as part of that, you lift up your body, you can look to the horizon, you kind of walk a bit more confidently. I think it genuinely is seen in body language as well, which is crazy when you think about it. What are some of the red flags you see either when someone's trying to raise money or in the first 6 months after they've you've invested?
I think red flags are pretty different to mistakes. So let me do red flags first, and then we can come on to maybe common mistakes. Red flags during a process, anything that feels like there isn't 100% transparency will be us gone straight away. So, we didn't really tell you about that contract that's churning. It's not really ARR. Or, well, we said this was going to happen. We sort of knew it wasn't going to happen, but we didn't tell you that because we thought it might affect the conversation. That doesn't work for us.
Yeah.
I think we want to be the VC that you ring when you lose the massive contract, because you want to talk to someone friendly about what the right next steps are, not the last person you ring because you're trying to construct the narrative and the story that you think is going to sound great to the person who's sitting on your board. And there's a real radical difference between those two, and we try really hard to be the former because it's very important, and that's what will create value between us and the entrepreneurs, is them knowing that yes, we'll be hard, yes, we'll be critical, but ultimately we'll be very supportive. We will be there to try and work out what's in everyone's interest if that big contract's in trouble.
I mean, it's the foundation of a great relationship, isn't it?
Yeah, it's exactly right. And a relationship is really how we think about it. Yes, there's some documents and there's a board director and all those things, but actually you're building a relationship with these founders, and hopefully a really enjoyable one as well. Like, it will be a long time, and so enjoyable is just as important as fruitful. And the two, I think, coincide.
I mean, I think for founders there's a comfort to feeling that they can be honest about these things.
Yeah. So then if we go back to mistakes, I think the biggest mistake people make through a fundraise and subsequently after is they don't move quick enough on hiring compared to their plan. So you look at a B2B SaaS business, there is a real cadence at which you have to build the team in order to grow. And some of it's quite mathematical. If you're selling, you need sales reps. You need the mechanics of the go-to-market machine. And so they're raising Series A. They'll always have ambitious plans. Those ambitious plans will have big numbers 12 months out, because that's what everyone expects. Maintaining the growth rate that they had before, or a little bit less, but a really ambitious growth rate. But they're not hiring. They leave the Series A raise too late. They can't then hire the people. If they can't hire the people, then they'll raise the Series A. And unless they're really on it and they hire them very, very quickly, that growth rate will come down just mathematically. They can't grow quicker than the number of reps they have. So much as you might want to continue growing at 150%, you can't, because you haven't built enough of the infrastructure to do it. And then we see that mistake time and time and time again, of growth rates really coming down. Even from great entrepreneurs, now often they can inflect them because they understand the dynamics. They do then hire, business starts growing much more quickly again.
Yeah, that's so interesting. We're part of the way through 2025. How have you seen the first kind of second quarter of 2025 versus last year? And if you had your crystal ball, what would the rest of the year or even next year look like, do you think?
We've had a great first quarter. We are going to do more investments this quarter than probably we've ever done in a quarter.
Wow.
Which is fantastic. We're seeing a lot of really good businesses. The thing that's difficult for all VCs right now, and probably all investors at any scale, probably for all entrepreneurs as well, is the AI wave, is understanding what is going to get overtaken by the generic AI models and what is going to remain as a true independent company and entity. But what hasn't happened yet is AI has ceased to be magic. And so the reality is we are finding more businesses than ever that can give a 10x better outcome to a company. So if I'm selling to you, I can come up with a business that is going to drive your productivity way more than was true 3, 4, 5 years ago. And I think the rate that AI is developing, that's going to continue to be true for a while. Now, because I can deliver that value to you, that means that I can grow really quickly as a business. So there are lots of very fast growing, very innovative AI first businesses that are knocking the lights out. And that's really exciting as a venture investor, albeit with that scary lens of, are the generic models going to take over what that business is doing in 2, 3, 4, 5 years?
Yeah, and I guess we don't know necessarily where the generic models are going to go.
We don't know how fast they're going to develop, and we don't know where they're going to go.
Which I guess is VC risk, investing in
which
these
is VC
businesses.
risk. And so what do we try and do? We try and find other aspects to the business that we think won't get overtaken by those, be it a data moat, be it a depth of product that will be difficult for that generic model to ever have, even if it can do the base analysis, be it the ability for the company to plug into multiple different models to do different things. There are multiple ways that we think about trying to minimize that risk, but the world is moving very, very, very quickly, which is both great for the portfolio companies growing quickly and increases the risk level.
And for you personally, have you ever dabbled with the idea of becoming an entrepreneur?
I have. I think probably it was really in my mind when I moved into venture that's the sort of path I wanted to take. I think as you spend more time being a VC, you realize just how hard it is being a founder. I think my job is easier than being a founder.
Yeah.
That's the reality of it. I really enjoy being able to speak with and work with multiple different companies and multiple different founders. Yes, it can be frustrating that you don't get to really spend your time nailing a specific problem. But I think it is a very, very, very difficult and sometimes very lonely job being a founder.
Is there any commonality of advice that you tend to give more than once to founders in your portfolio or founders you see, things that you always seem to say quite regularly?
I think in founders, the thing I say more often than ever is you have to find a way to enjoy this, because it can be so all-consuming. And that sounds like really glib advice. And in some ways it is, but actually, going back to what I said before, it's an amazing achievement to have got to 1 million ARR. And there are always going to be a million things on a CEO's mind that they aren't going as well as they'd like to. There'll be a whole stack of metrics that aren't going as well as they want them to, and they're worried about budget, and they want to beat this, and they're what about their next round, and what about cash runway, and. But they need to find a way to position that so that they can be the best version of themselves. And I think they can only do that if they get to a part where they're enjoying it. And I think part of that is working out which bits they are differentially enjoy or are good at. Hopefully the two coincide, and scaffolding around themselves so that they can spend more time doing that and less time doing other things. The beauty of watching a business grow is they have more ability to do that. Obviously, as a 1 million ARR business, you just don't have that much capacity to hire people to do that scaffolding. Once you're at 10, 20 million ARR, actually you do.
It's super interesting, isn't it? Because essentially you're a solo rower, and you're actually trying to build a crew of experts to row in the direction that you've got a purpose to deliver and nail, and that helps you with the journey.
Totally agree.
Jonathan, thank you so much. It's always good to have a chat with you. Hope you enjoyed that.
It's been a pleasure.
And thank you again, and look forward to catching up with you again soon. Thank you.
Thanks.